Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Okay, let's just go ahead and get into it. The Federal Reserve announced today that they're going to raise interest rates by 0.5%, also known as 50 basis points. That's not news. We talked about it yesterday. We talked about it a few weeks ago. We knew this was a possibility, and they've been signaling this for quite a while. However, with their announcements and all the things they talked about today, there were two important things that really stuck out to me. I'm going to put a few of these on the screen and read these out for those who may be listening to the audio version. All right. Before we get into that, though, let's quickly talk about, for those who may be new to the channel, we get new subscribers all the time. Thank you guys for coming and liking and commenting and all those things. If you have not done that, this is your chance to hit the like and subscribe button. Aside from that, though, why do we do this, right? Why do they raise interest rates, and why is 0.5% so important? So remember, the last 4 times that the Federal Reserve has raised interest rates in 2022, it has been 0.75, and that is because they wanted to be more aggressive in trying to fight inflation. When you raise interest rates, you make borrowing more expensive, and that says, hey, look, maybe I don't want to borrow this money. Maybe I don't want to take out a loan. Maybe I don't want to, buy a home, a car, take out a business loan, and really hire all these people and try and grow as aggressively as possible. So what they're trying to do is say, hey, pump the brakes. That's the whole point. Now the Fed is saying, hey, look, we're really hitting the brakes harder the last 4 times. We're going to take our foot off the brake just a bit so we do not push the entire economy into a recession. Now, that is the explainer as to why they raised rates and why they raised it the way they did. Here are the 2 things that stood out to me, and I'll put these up as I'm reading some of these. And all these exact screenshots are from the New York Times. Now, the first thing is they are expecting prices to rise in 2023 by 3.1%. Now, as of right now, the most recent number we had was 7.1%. Interesting. They're going to get rates all the way from 7.1 all the way down to 3.1. That is their expectation, their forecast. I don't know how they're going to do that other than being even more aggressive with raising rates. Whatever they're going to do, that's what they're going to try and do. Then that would be great because, again, 2 to 3% is normal. That is their target rate. And I think we would all enjoy not seeing prices raise or go up by 7, 8, 9% a year. That is not sustainable. Okay. Now, it is normal for prices to go up 2 to 3%. 7 and above is way out of line. So they expect consumer prices to rise by 3.1% in 2023. And then in 2024, they expect prices to rise by 2.5% in 2024. Interesting. Now, again, these are projections, and right now these projections are 2 years out. There's a lot of things that can happen between now and then, but I hope they're right. I hope they're right, and I hope prices or inflation rather will come down to a more reasonable level. So that was the first thing that stood out. I didn't really expect, I don't know if there's a great guideline for this. I didn't really expect prices to go from 8, 9% in 1 year and then drop by 4% the next year. We'll see. That stood out to me. I didn't know they could drop that fast. So hopefully that's the case. We'll see. Now, next thing that stuck out to me was this. They projected that economic growth will fall sharply and that unemployment would rise notably, nudging the economy to the brink of recession. That has been a concern. We have talked about that concern, but it's interesting that you're going to come out and say that. Now, the other part of this is the unemployment rate is predicted to remain elevated in 2024 and 2025, a clear sign of how the Fed's efforts to control inflation will take a toll on workers and the broader economy. So it still sounds that, yes, they may have taken their foot off the brake a little bit, but it is still on the brake. And again, they're projecting all the way out into 2025. Now, y'all know me. I'm not the biggest crystal ball person at all, and I can only fathom predicting to a degree, or at least being reasonably confident, from 6 to 12 months. I have research to back that up. Now, the Fed is the Fed. Again, they got way more degrees than me. However, based on what they are saying, it's just interesting to project that far out. It does make sense for unemployment rate to come up just a bit. It also, on paper, does make sense that growth will, fall to a degree, or at least slow down. We did talk about this the other day because someone asked a question like, If they're going to raise rates, does that mean that everything is going to be stagnant and we're not going to grow? That is possible. That is possible. It doesn't have to happen. That is, however, probably the most likely scenario, and the Federal Reserve does agree with that. So those are the two things that really stood out to me. It's a quick video. We will be talking a lot more about what is going on in the market tomorrow. But again, they expect prices to rise 3.1% in 2023, and then 2.5% in 2024, and they expect slower growth and slightly higher inflation. Slightly lower growth and higher unemployment. We're at a 50-year low, close to a 50-year low, but they expect that to be slightly higher in 2024 and 2025. And the other thing too, well, I don't really want to see unemployment go up. I don't think anybody does. But when you're at a 50-year low, a slight increase isn't, catastrophic. So just keep an eye on it. It's going to be a bit choppy, which is why this week I will be giving our members, for our members only, I will be covering 6 stocks that are great for passive income through dividends, which might be real important if the next 2 or 3 years could be a bit rocky. The last thing I'll say too, because yes, I understand that saying all this and reading all this may feel very concerning and a little anxiety inducing. Just because the economy slows down does not always correlate to the stock market automatically falling. It doesn't automatically mean that 2023, 24, and 25 are all going to be very difficult years.
We're building something.
Yes, I am building something downstairs. I'm building a desk, y'all. So aside from all of that, it's not a guarantee. Okay, so we will see how things play out. We will see if these projections are even accurate. So there's a lot of things that happen between now and then, and we will see. All right, that is it for me. It is time to put my baby to bed. All right, I'll talk to y'all later. Bye.
I'll talk to you later.